the budgetary process every year starts with what is called the economic survey, a very underrated document, because the economic survey is a document that provides complete and comprehensive information about the Indian economy. It also prescribes certain measures to be taken for the genuine growth of the economy. Unfortunately, history has shown that almost none of those measures are actually implemented in the budget, because economics dominates the economic survey, politics dominates the budget. Now, the annual pre-budget economic survey is a paper prepared by the Ministry of Finance. It is tabled in Parliament by the Finance Minister, and it is the officially stamped and signed version of the state of the economy. All budget documents, including the economic survey, are available on this website, indiabudget.gov.in, a very comprehensive website, and they are always kept there. They are always available, even the previous budgets, previous speeches from the Finance Minister's speeches, to everything that you need to know about the budget. It's given there, and the economic survey particularly is probably a very good textbook on Indian economics. It's also pretty up to date, very well written, prepared by bright people, and I think we as citizens should sometimes make the effort to visit that website and read a little bit about especially the economic survey. Now, going into the first part of the budget, which is the finances of the government. To understand the budget, there are two important measures that we must comprehend or take into account, because they tell us quite a bit about the budget. And the first is the gross domestic product, or the GDP, and the second is the gross fiscal deficit, or simply called the fiscal deficit. Now, the gross domestic product, or the GDP, the most comprehensive definition that I have come across is this: the total market value of finished goods and services produced in the country in a given year, plus income of local residents from investments made abroad, minus income earned by foreigners from the domestic market. So today it's a more globalized environment. It's simply the total economic value added in an economy during a year, subject to the next two, because you can sit here today in India, invest abroad, so those gains are to be taken. You're going to account for them here, you're going to be taxed on them here. Similarly, we have opened our markets to foreigners. So foreigners who see an opportunity in India would invest here, but of course they are going to take their profits and probably one day even the capital out of the country. So those adjustments are of course made to the GDP. Now, in a very vast country like India, or for that matter even the so-called advanced countries, it is of course impossible to estimate the GDP correctly. It's more of a guesstimate. This is of course in lighter vein, but it's more of a guesstimate. But there's also a lot of criticism about the GDP as a measure. Well, until we find something better, we have to make do with it. Now, in sheer numbers, it's a gigantic figure: 2,04,42,233 crores. That means probably after that last digit 3 there, you have to add another 7 zeros to get it in rupees. But the figure by itself may not be meaningful. What is important is the growth rate, because that tells us a lot about how the economy is doing. Now, for months, maybe more than a year, everyone has been talking about a so-called slowdown in the economy. Some people go to the extent of describing it as a recession. And the GDP tells us something about this. The growth rate in 2018-19 was 6.8%, the previous financial year. And in this financial year, the estimate is now 5%. And this estimate is I've taken it from the budget documents itself. A lot of economists, and some of them quite sound and learned, say that the actual GDP figure could be lower than this. But even a 1.8% decline in GDP over just one fiscal year can be serious. So there are absolutely no doubt that there is a serious slowdown, to put it charitably, a very serious slowdown in the Indian economy. Now, understanding the fiscal deficit is also important. And when we talk about the fiscal deficit is very simple to understand. It is the shortfall that the government has in meeting its expenditure. After all the revenue streams of the government, there is a shortfall in meeting expenditure, and this shortfall has to be met. The government meets it by borrowing. So the gross fiscal deficit is what does the government have to borrow in order to meet its expenditure after taking into account all income. And that figure is always expressed as a percentage of the GDP. Now, the figure advised for a country like India is 3% of GDP. It should not exceed 3% of GDP. Unfortunately, in terms of just the size, the government expects to borrow 7,96,337 crores during the next year. That is, if its targets are met, this is going to be the size of the fiscal deficit. This is the amount the government is going to borrow to meet its expenditure. And in terms of percentage, it is 3.8%. Actually, it was supposed to be 3.3% or even get it lower, but the government has actually increased the fiscal deficit because of a slowdown in its revenues because of the economic slowdown. So this once again is fiscal deficits are generally there everywhere. And the government, of course, is not like a normal household. The government has certain other measures, economic measures that they can take, monetary measures, fiscal measures, but essentially a fiscal deficit beyond a certain point is not good. And India so far, even the last couple of decades, has not really been able to meet its own fiscal deficit targets. Once again, in lighter vein, an orderly system for living beyond your means. The government always lives beyond its means. Okay, the government finances are, you can compare the physics term for it, a black hole. A lot of things disappear into this black hole. Now, when we talk about any budget, it's a very complex exercise. I mentioned about the economic survey. If you actually go through the economic survey document, download it and go through it, you'll begin to understand just how vast this country is, just how vast its economy is, and just how difficult and complex any exercise to prepare a budget would be. Having said that, any budget that is prepared must be viewed in the economic context in which it is presented. And mercifully, there is at least now, at least during the last few months, there is an attempt to come face to face with reality. At last, people are no longer living in denial. They are admitting that there is a slowdown. And beyond that, we are facing today one of the worst debt crises that we have ever seen in independent India. So in more than 70 years, tremendous debt crisis. Only those who know, who are in the financial markets, understand the implications of this crisis. We are now into the 7th year of a very, very serious recession in real estate. Unlike other borrowings, real estate borrowings, liquidity can just evaporate in the real estate market. And it is not easy to liquidate real estate assets. It's easy to borrow against real estate, borrow for real estate, whether as a purchaser of real estate or as a promoter and developer. But let the market turn bad, the first thing that disappears is liquidity. Now, the first victims of this whole issue were the banks, because banks had lent heavily to the real estate sector. When the RBI got wind of what's happening, the RBI issued various circulars discouraging banks from lending further to the real estate sector. So there was a vacuum, money was needed, no money coming in. The NBFCs, non-banking finance companies, took the place of the banks. But the result was the same. The NBFCs went belly up, and in September 2018, we had you can say the beginning of the debt crisis, when a very large infrastructure company called Infrastructure Leasing and Finance, IL&FS, virtually went bankrupt overnight. It's a huge conglomerate, and that was followed by companies of the Z Telefilms Group, the SL, Anil Ambani Group, even a highly respected and admired company called Diwan Housing Finance Limited, DHFL. They all failed, and those failures are continuing. They are not going to stop. They have affected a lot of investors in a lot of ways. We'll come to that a little later. So there is no doubt that we are facing a very serious debt crisis. For a larger picture, we are also facing a very serious economic meltdown. Now, what was needed in this kind of a situation was bold budgetary measures that could boost morale. It's very important. Morale is as important to an economy as it is to a sports team or the armed forces. And lift people's spirits up, kickstart economic activity. You can use the word CIJ. These were the three focuses. C for consumption, I for investment, J for jobs. This is what was needed. Increase consumption, increase investment, increase jobs. Now, when we actually talk about any economic activity, in India, we look to the political class for leadership. And in the context of economics and finance, the leader of the country is the finance minister. And one of the finest sayings that I have come across on this whole concept of leadership is by J.K. Galbraith, a very, very famous economist. And several decades ago, he was the US ambassador to India. He was a great friend of India. And J.K. Galbraith says this: all of the great leaders have had one characteristic in common. It was the willingness to confront unequivocally the major anxiety of their people in their time. This and not much else is the essence of leadership. Take care of the pain points, take care of the anxiety, take care of the fears of your followers. And like I told you, those three important things, consumption, investment, jobs, we needed very bold steps to tackle these. So let's now look at section by section of the budget. That's, of course, I've chosen only those sections that are of immediate interest to a common person. And going into income tax, the two priorities of the finance minister, at least in her speech, were, one is, let us simplify. She used the word riddle. The Income Tax Act is riddled with exemptions, riddled with this, that, and the other complexity. So we want to simplify. Second was, we want to give away something. We are going to take a hit to our balance sheet because we are going to put more money in the hands of the people. And that money is supposed to kickstart consumption again. Unfortunately, what was done does not gel with what she had in mind. Earlier we had 4 slabs, now we have 7 slabs. Is this simplification? Earlier we had one system of taxation. Now you have a choice between 2 systems of taxation, one with deductions, one without deductions. Once again, is this simplification? Warren Buffett said it beautifully. There seems to be some perverse human characteristic that likes to make easy things difficult. So here is the slide showing 2 systems of taxation, one the old and one the simplified version. Even at first glance it does not look simpler. Okay, 7 slabs instead of the old 4 slabs. And Ronald Reagan said this: the most terrifying words in the English language are, I am from the government and I am here to help. Now, to avail of the new lower tax regime without deductions, you will have to give up certain exemptions. Let's have a quick look at some of the main exemptions you will have to give up. The one that people are most familiar with, Section 80C up to 1.5 lakhs, Section 80D, which can be up to 25,000 rupees if you are not a senior citizen, and if you're looking after a senior citizen or you are a senior citizen, it can go right up to 50,000 rupees of premium. That makes a difference. The largest exemption of 2 lakhs given on finance for a self-occupied house, housing finance. 80CCD, a specific section only to the NPS, National Pension Scheme. 80E for those who take education loans, of course only the interest portion of that. And for the salaried, the section 16, 50,000 of standard deduction, and a few more other benefits under section 10, including house rent allowance and leave travel concession. So the new so-called lower slabs are going to be yours only if you are prepared to give all these things, which means it's very simple to analyze. The higher the exemption you are claiming, the lower the benefits for you under the new scheme. So it's an exemption thing. If you're not claiming any exemptions, the new one is better. If you're claiming exemptions beyond a point, definitely the old system is better. Now, a few exemptions have not been done away with mercifully, and they are employers' contribution to the NPS, transport allowance for differently abled employees, conveyance expenses for employment-related travel, and of course for those who are earning rental income, the 30% standard deduction on rental income, it makes a difference. For those who are earning rental income, it makes a difference. So this 30% of standard deduction still continues to be in force even under the new regime. Which option is better? The finance minister gave an example in her speech of somebody with an income of 15 lakh rupees per annum who is not claiming any exemptions. 15 lakhs I'm earning, not a single rupee am I claiming as an exemption. I would have to pay 2,73,000 rupees of income tax under the old regime. But under the new regime, my tax drops to 1,95,000 rupees, and the saving is quite an impressive 78,000 rupees. But what if I'm claiming exemptions? Let's take a few of those exemptions. Supposing I'm claiming 1.5 lakhs under Section 80C, I'm claiming 25,000 under Section 80D for health insurance. I'm claiming 2 lakhs for interest on housing loan. Now my tax liability will not be 273. It will drop to 156, which is 39,000 lower than the 195 she talked about under the new scheme of taxation. So like I told you, the whole value of the new system depends upon the extent of exemptions that you are claiming. Now the Hindu business line did quite a good job of coming out with a break-even rate analysis to help people decide. This is a guideline. Your individual cases should be examined by you, and if necessary your chartered accountant. Don't go blindly with this, but this is pretty good, let me tell you, because I've examined it. What's the example here? The example is, you forget about the last two columns. Take an example of somebody who is earning 10 lakh rupees per financial year. If this person is claiming 1,87,500 rupees or more of exemptions, the old system is better. Okay, I'm earning 10 lakhs. I'm claiming deductions and exemptions from savings or otherwise of 1,87,500 rupees or higher. Immediately, the old system is better. Suppose I'm earning 10 lakhs. I'm claiming only exemptions of 1 lakh. Forget those exemptions, the new system is better. You'll end up paying less tax. Now, what are the lessons for taxpayers? The first lesson is, do a little bit of your own analysis. Go to your last income tax return. That is the starting point. Then have an estimate of what you're earning this year. What is the tax you're likely to pay under the old system if you're claiming exemptions? What are you going to pay under the new? A little bit of homework has to be done. And of course, not everything can be done by us. We ourselves know a little bit about finance and investment, but all our tax matters are always referred to our chartered accountant. Okay, so always, those of you who are with good CAs, please consult your CA. The CA is the correct professional to advise you on tax and tax related matters. One thing that as an individual investor you can remember, you have the advantage of shifting between the two systems of taxation every year. So if you come across an advantage after 1 year, you can shift back. This cannot be done by people who are earning business income. But if you do not have business income, if all your income is from other sources, for example salaries or whatever, you can shift between the two systems, and that is an advantage that you have. Now the new option of lower tax benefits one class of people. Who are those class of people? Those who are not claiming exemptions, or those who cannot afford to claim exemptions. There's a very unfortunate class, I also come across them, who work hard, earn well, they are not able to save a single rupee because of certain personal issues. They may have to pay off the loans of certain family members. They may have to provide for something like repairs of a house. They may have to provide for the education upkeep of some siblings and others. They may have to provide for medical expenses of people. These are really unfortunate cases. We see them, they come to us. We try our best to release some money from somewhere for even the most humble saving. Sometimes we cannot do it. Sometimes we cannot do it. So for such people, certainly there is relief. Like I told you, that example given by the finance minister is absolutely correct. If they were earning 15 lakhs, suddenly 78,000 rupees more comes into their hands. So continuing with our lessons for the taxpayer, for the future, the finance minister has very clearly indicated that the old system is not going to last for long. There's going to be a slow shift to slightly lower taxes, but doing away with all exemptions. So this also we have to prepare for. One area in which I'm certainly going to criticize the government is their short-sightedness in planning to do away with exemptions that encourage savings. This inclination towards doing away with exemptions is not just endemic to India. All advanced countries have also done it or tried to do it, but none of them have discouraged savings. All the other exemptions, deductions they have got rid of, but long-term savings they have kept it open. Why? Because retirement is important. People's lifespans are increasing. Look at the obituary columns of leading newspapers, Times of India, Mumbai, for example, say 60 years ago. You'll find a lot of people dying in their mid-50s, 60. Today, nobody bats an eyelid when somebody is into their 80s. As they say, 80 is the new 60. So it's good. And that's a phase of someone's life which can be enjoyed. But retirement and saving for retirement is very, very important. I always, when I give my investment classes, I ask the participants to just meditate for 1 minute. You don't have to meditate beyond that. You retire at 60, you're going to live till 90. 30 years. Compare that 30 years with the 30 years that went before it. 30 to 60 versus 60 to 90. In this period of 60 to 90, which is something like another working life, our capacity to work and earn money decreases. Our susceptibility to disease increases. Our capability of withstanding financial shocks decreases. Uncertainties will be more than certainties. So there are a lot of these things, and if no one is going to prepare for retirement, It will be the government who will have to spend tons of money trying to take care of people, on increased healthcare costs, on other benefits. It's in the government's own interest to provide for situations where people are financially stable, financially sound towards the last 2 or 3 decades of their lives. And this is very important. And while a lot of people, the kind of people who are probably listening to this webcast, clients of Simplus who are advised, you're with Simplus, for example, simply because you are an investor. You have an intention to invest, regardless of tax incentives. But there are millions of people who will not invest unless there's an incentive. And the government must take care of them also. Be careful of words like simplification. One more example is the tax collected at source proposed on something called the liberalized remittance scheme. The Reserve Bank of India allows resident Indians, please note, resident Indians, to take out of this country an amount of 250,000 US dollars per financial year. So if you have the resources and you want to take out money, this is February, you can take out $250,000 now. 2 months later in April, new financial year, you can take out another $250,000. That's how it works. And for any bona fide purpose. It can be for your own living expenses abroad if you want to stay abroad for some time. It can be for upkeep of any family members. It can be for medical expenses. It can be for investment. If you're allowed to purchase property somewhere or you want to invest in any financial markets, it can be for, and it is principally used in India for higher education of children. Now on that, they have imposed a tax collected at source of 5% if you have PAN and Aadhaar, 10% if you don't have these. It's just going to make people's lives more complicated and more difficult. Of course, this money does not disappear. It is like TDS. You have to file your return. And if in the return you have already paid enough tax and there's an excess of tax paid because of TCS, it will be refunded to you. But it's a painful process. Money is blocked unnecessarily. As it is, higher education can be frighteningly expensive. Easily 1 crore for 4 years of undergrad studies. And depending on what kind of postgrad you're doing and where you're doing it, it would be another crore for postgrad studies. So it all depends on that. So the words that they use unfortunately do not match with the actions that follow. And the government is constantly on the lookout for trying to raise money from any source by any means possible. And this is of course in lighter vein. Continuing with the income tax, under the new simplified regime, the lower tax regime rather, I'll put it, they are going to provide you with pre-filled income tax returns. Now, this may be a convenience, but this is not to be depended upon. Okay, always prepare your return carefully, accurately, and wherever needed, consult your chartered accountant. There was a pretty useful report that everybody has access to these days called the Form 26AS report, which gives you essentially what incomes you have earned and what tax has been deducted on those incomes. It helps you locate some incomes that you may not be aware of and kind of match your income tax return to that form. Now that is going to be expanded. It will include property and stock market transactions, and you will have to match this. If they are going to provide you with this kind of information, it is good. It helps you make your returns more accurate. Most chartered accountants are already depending upon this report when they are preparing people's tax returns. Scrutiny, appeals and other processes are made online and faceless. This is controversial. A lot of experienced chartered accountants to whom I have spoken, they say that an appeal sometimes involves very intricate and delicate matters of the law. These are not things you can just go by ticking some box or just 2 or 3 sentences on in an online answer. These require a face-to-face convincing of an income tax officer. Maybe for simple clarificatory matters, these would be good. And disputed cases are given the option to settle the dispute and pay the tax without penalty and interest before 31st March 2020. There's gigantic tax litigation in this country. And the tax litigation is on account of only one thing: the complexity of the tax law and the constant changes to the tax law. As we say, in matters of tax in India, the only consistency that we have is our inconsistency.